Welcome back to A Real Estate Wisdom with Vish. If you own a home, you are thinking about buying one, you're trying to sell one, you're renting, you are investing, or you are simply wondering what the heck is happening with real estate in the GTA, this episode is for you. Because we are halfway through 2026, and I think it's time to take a step back and ask a very simple question. Where is the GTA real estate market actually heading? Not where social media says it's going, not where the person at your dinner table thinks it's going, and not where someone trying to sell you something tells you it's going. Let's look at the numbers. We are going to talk about the GTA resale market, detached, semi-detached, and townhomes, the condo market, new construction and pre-construction, the rental market, interest rates and affordability, what I'm watching for the rest of 2026, and most importantly, what should you do on depending whether you are a buyer, seller, renter, landlord, or investor. And I'm also going to tell you a story about a buyer I was speaking with that I think perfectly illustrates the market we are in today. So let's get into it. Let's start with the headline. The GTA market has not suddenly turned into a runaway seller's market, but the market is changing. And that's the important part. At the beginning of the year, we were dealing with a market characterized by relatively weak demand, affordability challenges, and plenty of choice for buyers. But the second quarter brought a noticeable improvement. TRREB reported 6,770 GTA home sales in June 2026, up 9.4% compared with June 2025. At the same time, new listing fell 12.9% year over year to 17,282. That combination is important. More sales, fewer new listings, and therefore a gradual tightening of market conditions. TRREB's own assessment was that the GTA could see accelerating transactions and increased competition during the second half of 2026, potentially leading to renewed price growth. Then we got July. TRREB reported 5,995 sales in July 2026, only 0.9% below July 2025. So we are not seeing explosive growth, but we are also not seeing the market falling apart. And that's my first major takeaway. 2026 is looking much more like a transition year than a crash year. Now, let's talk about the question everybody asks me. Vish, are prices going up? My answer, eventually, probably, but that's not the same thing as saying prices are going to explode. In June, the GTA average selling price was $1,058,658, down 3.9% from June 2025. The MLS HPI composite benchmark was down 5.4% year over year. But both the average price and the HPI showed slight month-over-month improvement on a seasonally adjusted basis. So we are seeing something interesting. The annual numbers still look negative, but the direction of travel is beginning to change. And that's something I watch very closely. Because real estate doesn't turn around when the headlines say prices are rising. Usually the market starts turning before the headlines catch up. First you see inventory tightening, then sales improving, then buyers becoming more confident, then multiple offers starts appearing in specific segments, and only later do the headlines price statistics really start moving. Let me give you a real world example. Imagine a buyer named Mike. Mike has been watching the market for almost 2 years. He's been saying, I don't want to buy yet. Prices could fall another 10%. Fair enough. So Mike waits. He watches prices decline. He sees more listings. He negotiates aggressively. He feels very comfortable. Then suddenly he finds the house he actually wants. It's in the neighborhood he likes. It's the right size. The schools work for his family. The commute works. And the price is reasonable. Mike makes an offer. But this time, there are 3 other buyers. He doesn't get it. A month later, another property comes up. Same thing. 2 offers. Then another. 3 offers. Mike says, wait a minute. I thought the market was down. And that's a lesson. A declining market doesn't mean every property is getting cheaper every week. Real estate is incredibly local. A GTA-wide statistics might say prices are down 4%, but a particular neighborhood, street, property type, or price range might be behaving completely differently. That's why I always tell people, don't buy the market, buy the right property. And if you are selling, don't sell the market, sell your specific home. Now, let's break down resale. I expect the resale market to be the strongest part of the GTA housing market during the second half of 2026. Why? Because resale has something new construction doesn't always have. Immediate usability. You can see the house. You can inspect it. You can compare it with other homes. You know the neighborhood. You know the property taxes. You know the condo fees. And most importantly, you can move in. For buyers, this creates a significant advantage. There is still choice, but choice is becoming more selective. The best properties are going to attract attention first. Think great location, good schools, functional layouts, parking, outdoor space, well-maintained homes, reasonable price, strong transit access, and properties that don't require a massive renovation. The homes that are overpriced, they can still sit. This is not 2021. You cannot put a mediocre house on the market, price it aggressively, and assume 10 buyers will fight over it. Pricing strategy matters again. If you are a homeowner thinking about selling this fall, here's my advice. Don't ask how much did my neighbor sell for. Ask what are today's buyers willing to pay for my property. Those are 2 completely different questions. If you are selling 1.3 million house in Oakville, for example, you are competing against today's inventory, not against what someone paid for their house 2 years ago, not against what your house worth at the peak, and definitely not against what you think you deserve. The market doesn't care what you paid. The market doesn't care how much you spend renovating. The market cares about value, so sellers need to be realistic. Prepare the property, priced strategically, create strong first impressions, and understand your competition. Now, let's talk about the elephant in the room, condos. And this is where I want buyers and investors to pay very close attention, because the condo market is behaving very differently from the overall resale market. Urbanation reported that GTHA new condo market entered 2026 in extremely difficult conditions. In Q1, only 246 new condos were sold, down 52% year over year and 94% below the 10-year Q1 average. At the time, there were 4,295 completed but unsold new condos, a record high. Urbanation estimated that this represented approximately 92 months of completed new condo supply based on the previous 12 months of sales. That's enormous. But here's where the story gets interesting. Urbanation reported that Q2 new condo sales increased by more than 50% year over year. So we are seeing the first signs that the market may be stabilizing. But stabilization does not mean the problem has disappeared. Why condos are under pressure? There are several reasons. Number one, affordability. Number two, investor economics. Number three, high carrying cost. Number four, competition from resale condos. And number five, a large amount of completed inventory. Urbanation reported that in Q1, developers asking prices for standing inventory average about 1,189 per square feet, compared with approximately 859 per square feet for comparable recent resale condos. That's a huge gap. Now imagine you are a buyer. Why would you automatically pay a massive premium for a brand new condo if you can buy a 3-year-old condo in the same neighborhood substantially less? That's a problem developers are facing. And that's why we are seeing incentives, price reductions, upgrades, assignment opportunities, closing incentives, and other strategies designed to move inventory. But here's the twist. This is where I think the condo story gets very interesting. Because the current weakness in new construction is creating a future supply problem. Urbanation reported that condo construction starts have fallen dramatically. And the number of condo completions is also expected to decline. Urbanation estimated approximately 21,850 condo completions in 2026, down from roughly 29,600 in 2024. It expects completion to fall further in 2027. So today's oversupply problem could eventually become tomorrow's supply shortage. That's real estate. The cure for low prices is often low construction. And the cure for high prices is often more construction. The problem is that construction takes years. You cannot decide today what you need 50,000 condos and have them available next spring. Now, let's talk about buying new construction. If you are considering a pre-construction property, I want you to forget one phrase. It's a good investment because it's new. New does not automatically mean good investment. You have to look at purchase price, comparable resale values, maintenance fees, property taxes, financing, occupancy cost, closing cost, HST implications, assignment restrictions, builder reputation, construction timelines, rental potential, and many more. And there's another major consideration. When will you actually take possession? Because you are not buying today's market. You are buying a future market. If you are purchasing something that won't close for 2 or 3 years, you are making a bet on what the market, interest rates, rents, and neighborhood will look like at that time. That's very different from buying a resale home today. Now, let's talk about renters. And renters are finally getting something they haven't had in a long time. More choice. TRREB's Q1 2026 condominium rental data showed 24,000 rental listings, up 6% year over year. At the same time, 16,365 units were leased, up 10.6%. Average rents declined across every bedroom category. The average one-bedroom condo rent was $22.46, down 4.1% year over year. The average two-bedroom rent was $29.39, down 3.2%. And the average three-bedroom was $3,757. That doesn't mean renting suddenly become cheap. Let's be very clear about that. Housing is still expensive. But the balance between landlords and tenants has shifted, and that's significant. Why renters have more power? CMHC 2026 mid-year rental update tells a similar story. Increased supply and slower demand have pushed asking rents lower in several major markets. The biggest easing has been concentrated in newer, high-priced rental units. Some landlords are offering incentives such as free or discounted parking, move-in credits, gift cards, and in some cases, free rent incentives. But here's the important nuance. Not every renter is benefiting equally. CMHC says lower rent segments remain tight. So, if you are looking for a luxury one-bedroom downtown, you may have negotiating power. But if you're looking for an affordable family rental, you may still find very limited choice. That's why averages can sometimes be misleading. What does this mean for landlords? If you're a landlord, this is a wake-up call. You can't simply say, my property rented for $3,000 last year, so I will list it for $3,200. You need to know what competing units are actually offering. If your tenant can choose between 5 similar units, you have to compete. And that doesn't always mean lowering rent. Maybe you offer parking. Maybe you improve the unit. Maybe you include something else. Maybe you price slightly below the competition and secure a strong tenant quickly. The goal isn't maximum rent. The goal is maximum risk-adjusted return. A vacant condo earning $0 is not a better investment than a properly priced condo with a reliable tenant. Now, let's talk about the biggest variable affecting the market, interest rates. The Bank of Canada had its policy rate at 2.25% following its March 2026 decision. But here's the mistake I see people making. They wait for the Bank of Canada to announce a big rate cut before they start shopping. That can be dangerous because mortgage rates don't move in perfect lockstep with the overnight rate. And the real estate market doesn't wait for everyone to agree that rates have become affordable. Markets anticipate. So if borrowing conditions improve and buyers regain confidence, demand can start increasing before the statistics fully reflect it. And remember, the Bank of Canada's own financial stability report has highlighted the mortgage renewal issue, with some borrowers facing higher payments when they renew. That creates another layer of complexity. Some homeowners will have more financial pressure. Others have built significant equity and have manageable payments. Again, one market, very different experiences. What I expect for the rest of 2026? So here's my forecast. And let me be very clear. This is not a guarantee. Nobody can predict real estate perfectly. But based on the data we are seeing, I expect the second half of 2026 to look something like this. Number one, more resale transactions. I expect sales activity to continue improving from the weak levels we saw earlier in the year. Why? Because affordability has improved from the peak. There's pent-up demand, and buyers who have been waiting are beginning to re-enter. TRREB itself expects more transaction activity and competition during the second half of the year. Number two, prices stabilize before they accelerate. I don't expect a massive GTA-wide price explosion. I expect stabilization first. Some markets may see modest gains. Others may remain flat. And some segments, particularly condos, may continue to underperform. Number three, detached and family-oriented properties should outperform condos. especially in desirable suburban markets with strong schools, transportation, and limited land supply. Think Oakville, Burlington, Mississauga, Milton, and selected parts of Brampton and Hamilton. But again, property specific. Number 4, condos will remain the most negotiable segment, especially investor heavy buildings and buildings with large amounts of competing inventory. This could create opportunities for buyers, but don't confuse a lower price with a good investment. Do the numbers. Number 5, rentals should remain relatively tenant friendly, especially in newer high priced buildings. But affordable rentals will remain competitive. Number 6, new construction will remain under pressure. Developers will need to become more creative, more incentives, more pricing flexibility, more rental conversions, and fewer projects launching. That reduced construction pipeline is something I'm watching very closely. So, what should you do if you are buying? My advice, don't try to perfectly time the bottom. Instead, identify your budget, time horizon, location, property type, monthly carrying cost, down payment, financing comfort, and long-term objective. If you are buying a home to live in for 7-10 years, getting the perfect $25,000 discount may not matter nearly as much as buying the right house in the right location. But you should absolutely negotiate. Today's market gives buyers leverage that didn't exist a few years ago. Use it. Get inspections. Review documents. Compare properties. Negotiate the price. Negotiate conditions. And don't fall in love with the property before you understand the numbers. If you are selling, don't chase yesterday's price. Price for today's market. Your first 2 weeks on the market are extremely important. If you overprice by 10%, sit for 30 days, then reduce. You may actually end up selling for less than if you had priced correctly from day one. Buyers have data. They can see what else is available. Your house isn't competing against the house down the street from 3 years ago. It's competing against the property listed today. If you are an investor, this is probably the most interesting market we have seen in years. But it requires discipline. I would focus less on where will price be in 6 months and more on, does this property make sense at today's numbers? Calculate purchase price, down payment, mortgage, property taxes, maintenance fees, insurance, vacancy, repairs, property management, and realistic rent. Then ask, what is my actual return? And here's another question investors should ask. If prices don't increase for 5 years, am I still comfortable owning this property? If the answer is no, you may be relying too heavily on appreciation. If you are renting, this is probably one of the better negotiating environments you have had in several years. Don't just accept the first asking rent. Compare. Ask questions. Look at multiple buildings. Understand whether parking is included. Ask about incentives. And if you are planning to rent for another couple of years, don't feel pressured into buying simply because someone tells you. Rent is throwing money away. That's an outdated argument. Renting can make sense. Buying can make sense. It depends on your financial situation, lifestyle, and time horizon. The bigger picture. So where does that leave us? Here's how I see the GTA market as we move through the rest of the 2026. We are moving away from the extreme buyer's market conditions we have experienced in some segments. But we are not going back to 2021. And honestly, that's probably healthy. A sustainable real estate market isn't one where prices jump 20% a year. It's one where buyers can afford homes, sellers can transact, builders can build, landlords can operate, renters can find housing, and homeowners can comfortably carry their mortgages. That's the market I want to see. So let me leave you with this. If there's one thing I want you to take away from today's episode is this. Don't make real estate decisions based on headlines. The GTA is no one market. It's thousands of micro markets, different property types, different neighborhoods, different price points, different buyers, different sellers, and different financial situations. The person buying a $700,000 condo has a completely different market from the person buying a $2 million detached home. The landlord renting a luxury condo has a different market from the landlord renting an affordable townhouse. And the investor buying a pre-construction condo has a completely different risk profile from the family buying a resale home to live in for the next decade. So don't ask, is the market going up or down? Ask, what part of the market am I in? And then what does the data tell me about this specific market? That's where the real wisdom is. And that's exactly why I created this podcast. To cut through the noise, to look at the numbers, and to help you make better real estate decisions. If you found this episode valuable, please subscribe to Real Estate Wisdom with Vish on YouTube, Spotify, or Apple Podcast. And if you know someone who's thinking about buying, selling, renting, or investing in real estate this year, send them this episode. Because the best real estate decision isn't necessarily the one that makes you the most money. Sometimes it's the one that gives you the most financial security, flexibility, and peace of mind. I'm Vish. Thank you for listening. And remember, don't follow the market blindly. Understand it. Then make your move. I'll see you in the next episode of Real Estate Wisdom with Vish. Bye for now. Disclaimer. The information provided in this podcast is for informational purpose only and should not be considered as financial or investment advice. Consult with your professional before making any real estate decisions.